This meeting is being live streamed. Folks, we're often racing. It's Tobias Carlisle. This is Value After Hours, joined as always by my co-host, Jake Taylor. And our special guest today is Zach Abraham. He's the founder, chief investment officer, CEO, the man at Bulwark Capital Management. How are you, Zach?
Doing good. Yeah. The guy that wears the hat. Well, it depends on how the performance goes, right?
Yeah.
Chief investment officer when we're winning.
Yeah.
When we're not, it's the analyst's fault.
Welcome, Zach.
Thank you, guys. Thanks. Good to be here.
Hey, we finally got our markets in turmoil. We're like down 1% or something.
Yeah,
like that. There's been so little volatility.
Oh my gosh, man. No kidding.
Panic.
What do you think, Zach? Where are we?
Well, just so people know, I was thinking about the last time we did this, and I was on with you. The last time I was on with you, Toby, was when I was still working out of my home office. So a lot's changed. If people remember, I'm a value guy at heart. So that probably uncovers me for being a little bit bearish at the moment. I don't want to be hyperbolic at all, but I think in a lot of ways, personally, I started running a portfolio in 2007. I've never seen a market that seems more detached from fundamentals than current. And when I say that, I don't mean that everything's insanely priced. I just don't see any rhyme or reason to how things are priced, right? It just seems like things are just floating. Like we keep joking around at the office. It's like stocks have become Pokemon cards, right? Where if somebody thinks it's worth this much this day, discount rates don't matter anymore. You and I were talking about off air. If you would have told me that the Fed funds rate was going to go to 5.5 and earnings were going to be down, margins were going to be down, pretty much the S&P, throughout the entire S&P, I think on an inflation adjusted basis, revenues are down year over year. And in that backdrop, you're looking at a market that's up 10% plus. I just falling profits and higher rates don't typically incite me to want to jump in there and buy. So I think that one of the things, I was looking back at a letter we wrote to our clients in 2021, at the end of 2021, and we said that, look, I think we're at the peak of this cycle, but it's going to be a knife fight just because it's been the longest, biggest bull market of all time. And you've had 0% rates pretty much the entire time. And we said, look, we think it's going to take a lot longer to get to normal, quote unquote. And we'd expect to see massive bear market rallies. So far, right, that's the way it's playing out. And in that light, I guess this year shouldn't surprise me, right? Everything has been bigger and longer and crazier. And this appears to be too, but I don't think it's going to change the ultimate resting place. I think we're going lower. I don't think we're on the edge of a morass. I don't think we're looking at some big 08, 09 black hole. And you know what's funny, guys, and I'd love to hear your thoughts. I feel like I've already been rambling, but I feel like you're really setting up for kind of a mini 70s type period where you're just kind of got to grind sideways for a long time while you digest the current valuations, which seem very stretched. I think peak margins are probably in the rearview mirror. I'm not a perma bear. I don't think we're about ready to fall off the face of the earth. I also don't think that this is the environment of a new bull market breakout either. I kind of think both bulls and bears are going to get smacked around, and I kind of think sideways chop for a while seems like the most logical position at this point, but we'll see.
It's very interesting to see the bond market versus the stock market and just how differently they're interpreting the current situation. I mean, I don't remember a time where it's been this far out of sync.
No.
There's clearly some disconnect. Bonds are, I saw John Hussman, who's, pretty bearish guy most of the time.
What?
He said that bonds today, he put them into like a zone of like reasonableness. Like he didn't think they were particularly out of whack. So you've got bonds that have persuaded one of the more bearish guys around.
He's constructive on bonds.
I don't know if he was constructive. He was just like less sort of.
I just like that term. It doesn't make any sense to me.
You know what amazes me about it, and this is not a slam at all. Like the guy's smarter than I am, which probably isn't saying a whole lot. But and I don't mean it. I just want his clientele base, right? Like, no, and I mean this. Like, that guy has managed to maintain really significant AUM, and for a long time, that performance has looked pretty meager.
To give him credit, he did have very good returns in the 90s. He was very bullish in the 90s. He's had a pretty good run, and he's been pretty clear about his strategy. I mean, people are there because they agree with his thesis.
Yeah.
And I have a lot of sympathy for his thesis too. I don't want to sound critical because I read his stuff. I enjoy his stuff. I don't think he's wrong. I just think that it takes a very long period of time for it to play out.
Same. I feel the same way, and I think that something that I've had to absorb over the last 15-year cycle, and it's probably what's got him, is you can look at what central banks and what governments have done in a lot of different lights. Obviously, again, there's a ton of different takes out there, but I think one of the easier ways to really understand it is so many macro stories and theses haven't played out because central banks are muting that, right? That's what their intervention is doing, is muting macro plays and macro flows and macro reactions. And if you look at the performance of a lot of macro guys over the last 15 years under that lens, kind of explains it. There were a lot of the macro events that I think got, I mean, think about when what's his name? I'm spacing that, whatever it takes, right?
Draghi.
Yeah, Draghi, right. If it wasn't for that sentence, I think the macro guys would have made a killing over the next 3 to 6 months there. So I think that I kind of see Hussman's argument is it has to be eventually right. It's just the timing of it, obviously.
And there's been lots of little scares of, SBV, gilts, and that's just even in the last, 12 months or whatever. But how quickly we just move on from that and just like put all that stuff like, those are old problems. We're past that.
You're literally, again, I don't want to be hyperbolic, but I think it's probably fair to say you were a week or two away from a complete national bank run on the regionals. I mean, maybe more, maybe it was a month, right? I mean, because the problem with those, right, is they feed on each other. It continues to get worse and worse.
It's a confidence issue.
Yeah.
Which, to give the Fed credit, like that's what they're supposed to do. They're supposed to stop those bank runs. So I don't know, I don't know if that's traditionally the way that it's supposed to be. It's supposed to be people lining up at the door and they just say, yeah, you're gonna get your money. Just
sit tight.
Just relax. Yeah. There's no chance that the bank goes under for liquidity reasons. I don't know if they're supposed to pull the handle, flood the market with capital just because somebody's having some struggles, but that seems to be what they've done. They've been bailing out hedge funds and so on.
Yeah, it's just because if you think about it too, it's really crazy to watch it morph, because I'm assuming we're all kind of in that same age range. When did you start in the business, Jake?
Call it 2007-ish.
Okay, so yeah, right around the same time I did.
Right at the top of value.
Right, yep, we're singing the same story.
Yeah.
But it's fascinating to watch. I mean, we all remember how crazy it was watching them pass TARP, right, in 2008.
Yeah.
If you think about it, that
tiny numbers.
Oh yeah, that SVB vehicle was 40% of TARP. You know what I mean?
Yeah.
And it didn't even make the news. It's just wild the way that you watch these things unfold. And I just think that's why I kind of think that, this lower for longer kind of thing is coming, because I feel like you couldn't have set up the market or market participants worse, because you have literally told them, if we take a 23% GDP shock in a single quarter, don't worry, right? We got you, right? And so I just think you have that Pavlovian response. You guys know as well as I do, the only way you've been wrong over the last 15 years is if you didn't buy the dip in tech, right? Like that's for 15 years. It's like a fifth of most people's lives, right? So I just think that that's going to be, and that's why we were kind of prepping clients back in 2021, just saying, look, I think this is the right time to make a pivot toward fundamentals and really be disciplined about it, but don't expect it to look good every quarter, because you're going to see these reflexive and Pavlovian rips. And that's kind of how it's played out. I still can't believe the NASDAQ is up as much as it is this year, but it's at the same time, I guess I'd say it wasn't surprising, given the backdrop.
It's been extraordinary to watch rates rise the way that they have. And as you say, to wind it forward 12 months and see the market where it is, I certainly didn't expect that to happen. But then if you look at every other crash, they do seem to have this very long, the 2000, 2002, 2007, 2009, like they are years long events, and they all have this same they have an early sort of sell-off that spooks everybody, and then it rallies back to almost the all-time high. It never quite gets there. And then it's that back half where all of the action seems to happen. And I think we saw that rally back to almost the all-time high, whenever that was recently, but it also didn't quite get there. And now we're into that part of the cycle where the Fed has been raising for now. I think they started in May last year. Do you guys know exactly when that started? It's been a while anyway. So the yield curve inverted in October, late October last year. Here we are. It's almost October. The yield curve is now halfway back from where, like at its full inversion, it was negative 1.89. We're at like negative 0.96, I think yesterday, or 0.93 yesterday. So like halfway, call it halfway. And it's taken a long time to get there. And so when you see that the actual crash, like the real carnage, tends to happen after the inversion goes back into normalization. So we're getting pretty close to that event. And maybe that's what now we're seeing, a little bit of the jitters, a little bit of the shakes. And I think the Fed keeps it raised until something breaks. I mean, why would they not? They'll be looking at exactly the same data that you and I are looking at, we're all looking at, and saying, well, we've put rates to 5% and stock market hasn't cracked, it's fine. Real estate market hasn't cracked, it's fine. There's just zero incentive to lower rates at this point. And there's plenty of punishment because inflation's still pretty high. So I guess they wait until something cracks. And the moment that it cracks, they start cutting. But we know there's a long lag. And it takes another 2 years for that to play through. That's my rough roadmap.
I couldn't agree with everything you said. And I think that the lag time is going to take longer this time, because credit, you're coming out of a period of time where obviously you had historically low rates really across the board, right? And then on top of that, this, in an environment that's unlike any we've ever seen with fiscal stimulus. I mean, if you
massive fiscal stimulus.
So anybody that wanted to get something financed or refinanced has, you know what I mean? It for the most part. And one of the things that I keep going back to, and again, I think one of the biggest issues this market is dealing with is one of perception. Meaning, when you look at stimulus, the other thing, people are like, well, wages are up a lot. This is the worst real wage growth over the last 2.5 to 3 years that you've had in history, right? So yeah, they're up, but up compared to what, right? And I feel like people are missing
purchasing power's down, even though wages are up.
Right. Which, that matters to the consumer. And the thing that I just cannot wrap my head around, and we've gone round and round and round about this. Again, you say the word recession, everybody's like, well, you're a perma bear. And you get, guys, historically recessions happen every 6.5 years, right? It's not like Independence Day, and a recession settles over the top of the White House and just nukes it, right? But when you remove 0% rates and stimulus, how do you expect things not to go back more similar to trend prior to COVID, right? Like people aren't going to keep purchasing new barbecues every year because COVID happened, right? And they're not going to keep remodeling their living room in their backyard. So, I just think you have all these things lining up where and could we be wrong? Sure. I just don't see a way out of a technical recession. I just don't see how it squares.
I've heard from that the phrase right now in private equity, real estate, maybe venture too, is survive to 25. And it's like, okay, rates will be lower by 25. And if we can just survive to there, don't sell any of your assets, just get through to 25 and you'll be back in the driver's seat. And I feel like the market it seems like it might be that attitude a little bit, like, okay, just survive to 25. I'm not going to sell anything. I'm just going to ride this.
Yeah. I mean, and the eerie thing about it, I know I'm not telling you guys anything that you don't know either, but man, isn't that the credo going into every single economic contraction, right?
Soft landing. Soft landing.
Yeah.
Same idea.
We're gonna buckle up and ride it out, right?
Soft land, no landing, Toby. Come on.
I saw a chart. Yesterday, like the number of articles with soft landing, and it always spikes into the really big recessions.
Right before.
Yeah,
big recessions.
Funny. Yeah.
Uh-huh.
The other thing that I think is interesting about this, and we talked about this on the last on our show recently, was and this always happens at the peak, but it seems like it's just happening in mass now, where it's sort of like investors are covering their ears and saying, I don't want to hear any bad stories. I had it reminds me of a little cousin I had. She was like 3 years old, and her parents would be disciplining her. She'd cover her ears and go, I don't want to hear any of those words. It kind of reminds me of that with investors right now, because like, let's take real estate, for instance, right? I saw an article the other day, housing volumes have fallen to a 28-year low or something like that.
Is that
Mortgage,
bad?
Yeah, right. And we all know price follows volume, right? It's an age-old adage in our industry. And they go, but median home prices are up 4%. And I started dying laughing, looking at that, going, look, if you look historically, and these rates probably aren't perfectly accurate, but about 20% of mortgages issued are jumbo loans, right? So by definition, about 80% of loans issued are less than that. And that's about correct when you look at the typical mix of real estate, right? All of your volumes, even throughout the Great Recession, the financial crisis, the disproportionate, good 2/3 of your volumes happen at that lower half of the scale, right? So you got more people. Okay, well, we know that the lower end this time is very unique. It's dried up much more than the higher end, which makes sense in this environment. The lower end has to access credit. A lot more people at the higher end don't, right? So you got a lot more cash buyers at that higher end. Well, think about that. Okay, so if you look at a mix, let's say all housing across the country is down an average of 20%. And I'm not saying it is, but I'm just saying, for sake of argument. And you change that mix of 80-20, houses below 700,000, 20% above 700,000. You change that mix to 50-50. And it's somewhere in there now, 50-50, 40-60, somewhere in there. Right? You can easily have a scenario where all houses are down 20%, but the median's up 5%. Right?
That's interesting.
It's a fallacy of composition. So when you actually bust into these markets, and we've looked at Austin, I've owned property in Phoenix that I've sold in the last 2 years. Okay, so I know that market well. I know this market up in the Seattle area very well. We're looking at Bay Area, California. When you start looking across those markets and you look at all the data that's available, 12 to 15 kind of seems about where you've pulled off from the peak. And yet the median price, everybody's like, oh, houses are hanging in there. They're not. It's just a fallacy of composition. It's the way that they're looking at, and people are like, oh, it's a conspiracy. And I go, no, right? What is it? 70% of the time economies are expanding. And the metrics that we build are useful in those periods of times. Right. But you get into a period of time like this that is extraordinarily abnormal. And it makes sense that those typical metrics that we use don't really work. And so I think that there's just an exorbitant amount of misconception out there. You just go through those real estate markets, and those people arguing that house prices are up 4% year over year, it's just not true. It's just not. And again, it's just these fallacies of composition. So, yeah.
Let me give a quick shout out to all. We get a pretty diverse group of people dialing in. So we got Luz, Delaware, Nashville, Tennessee. What's up? Wexford Island in the house. Toronto, Prague, Altamont Springs, Florida, Savonlinna, Finland. What's up? Pyongyang, North Korea. Good to hear you. I think you might be our first caller from there.
No way.
Santo Domingo, Dominican Republic. I think it's a joke. Cincinnati, Tallahassee, Glasgow, Shetland Islands. What's up? San Diego, Norberg, Sweden, Kensington, London,
German for
Durham, Gulf of Mexico, Bucharest, Romania, Raleigh. From the Empire, there's Julius Caesar in the house, Santa Monica, Bangalore, Guatemala, Milton Keynes. I can't remember whether I said that correctly or not. Got a few shout outs for you, Zach, in the comments here. So let's go equities for a little bit, because I know that I do talk a lot of macro. We did talk a lot of macro, but let's go macro equities. Small caps getting absolutely smoked. There was a Royce article out yesterday. They said that small to large, using EV/EBIT, biggest sort of spread that they've got in 28 years of data. The only time it was a little bit wider was March 2020 at the bottom. How do you feel about like the thing that they say? So they say small caps, the average PE in small caps is something like 12.5 at the moment versus a long run average of like 18.5. And it's already in an environment where rates have gone up. All of their borrowing costs are up. Small caps are really kind of already in their bear market. And then some of the criticisms that I saw in the tweets under that were, when I go through that list of, whatever it is, 2,000 stocks, I find it hard to find things trading at 12 times earnings. What do you think's going on there? Why is the macro data saying it's cheap, but when people dig through, there's not much that's sort of interesting? Is it all energy and real estate that the traditional value guys don't want to touch?
Yeah, I think that's part of it. I also think that, again, human psychology, and it's funny because we always want to assume that we're not part of it. And yet it's scary, man. I mean, we've had 15 years of, I was telling some of our younger employees the other day about some of the horror stories I've got over the last 10 to 12 years of holding value picks. I was telling them the story about PACCAR. We owned PACCAR for 5 years. Margins went up, the dividend doubled, and revenues rose 50%. And the only thing that changed was the price to earnings ratio. It went from 13 to 8. And so we, in terms of a business, was that a good investment? It was a great investment as a business, right? Problem is the equity didn't move. So I think that's a big part of it. I also think that when you start looking through, I'm not sure where it's at right now. I haven't really looked at it very specifically, but there was also one point where I think GameStop was the biggest position in IWM, something like that, right?
Possible.
Where you've had these crazy moves. So when you start looking, right, that same indexing impact that's happened to the S&P 500, it has certainly had an impact on the small caps too. So when we were going through that small cap index, you're looking through small cap value specifically, and you're looking and going, that's not value. That's not value. That's not value.
That is true.
Yeah, I think
I have noticed that.
Yeah, I think that, it shouldn't be a surprise to any of us, especially because we're all, individual guys looking at different individual equities and things of that nature. But it's really hard to find a corner of this market that does not look like it's been significantly impacted by passive, and just that market cap waiting, right? Just feeding on itself. You posted that thing just, what was yesterday, wasn't it? Which said that the medium weight, or the what is it called? The even weight.
Equal weight.
S&P was now negative on the year.
Yeah, that was yesterday. It's down more today. So S&P equal weight is definitely negative on the year, and I think that if you cut out the 7, the Magnificent 7, I think it's down. Or it's definitely down.
It's got to be. And so I think, but what I will say, and this is what I was saying earlier when we first got on, is, and this gets overused, in terms of value and in terms of opportunity, I think that I think there's tons of really target rich stuff out there. I think there's stuff that looks very tempting long term. It's just that, right, you got stuff that is crazy cheap. It just feels like suicide to buy it. And then you've got stuff that's still insanely expensive. So there are, energy is one of those. Where, look, I know I'm not the first guy to come on and talk about energy, but when you look at a lot of these companies, one of the things that I think people are missing here, guys, is what has happened in the last 2.5 years to these companies has been transformational, right? Like a lot of these companies have been choking on debt for 15 or 20 years. You know, a lot of them now, that ain't a problem. If not, they've completely paid it off. I mean, they may have the same ticker, but a lot of these names are not structurally the same company. You know, they're completely different. I do think it's going to be a wild ride. I mean, I don't think it's going to be easy to hold these things, but there is still, in my opinion, generational value to be had in the energy space and even in the commodity space.
What do you think about, so Michael Cow, who's been on the podcast, who more traditional like equity structure arbitrage, but he's sort of moved a little bit more macro these days, and his Substack and his Twitter account is a little bit more macro. And he talks about oil just being weak typically into a recession. And so if the recession does play out the way that we're all assuming that it will, then you'd expect to see energy weak into that, and you'd also expect to see energy equities follow suit. And I think that the energy equities haven't followed the oil price so far. Like the last few months, they've sort of disconnected a little bit. Is that fair? JT, you're shaking your head there a little bit.
Yeah, I would say that feels kind of fair. I feel like the price of oil has kind of come back up. What is it? Back up above 90?
I think so, yeah.
And the equity side has, in my experience, at least, not seemed to have participated as much. I was going to say, do you guys feel like it's fair to say right now that the crash is here, is just not evenly distributed?
Yeah. And maybe that's the way this goes, right? Maybe it's a wave hits this and a wave hits that. The only problem is because the market cap weighting situation has gotten so extreme, when tech gets hit, and this has been our thesis really the whole way along, which felt sort of dicey because it really cuts against the grain. But, we're really supposed to get our cues from the S&P 500. It's the biggest index. It's the most broadest reaching. We haven't been doing that since the end of 2021. We've been tracking the NASDAQ, and it has worked on a technical level. It has behaved much better in terms of understanding, what's coming at you on a technical basis. It's adhered to the levels much better.
What do you mean? What do you mean you track it? What do you mean?
Well, so when we get into an environment like this, we've got several different risk management techniques, but if we're really worried about market downsides, we really pay more attention when it comes to hedging our positions. We really pay more attention. We're value oriented. I mean, our value portfolio, that's how we pick everything, but we really rely on technicals on the hedging side, right? And we were tracking, we made kind of that decision, which felt a little bit crazy at the time, to use the NASDAQ as our indicator when to hedge and when to manage risk, as opposed to the S&P 500. We made that call at the end of 2021, and it worked much better. There were just several times where you had fake breakouts on the S&P. The NASDAQ was bumping up against the top of the range. It got beat back down. Where if you'd have been tracking the S&P, it would have told you to pull the insurance off.
What's the reason for that? Just more people are playing around on the NASDAQ than in the S&P 500.
Yeah, I mean, you look at every 401. We have an interesting, and you know this, Toby, but we deal with all retail investors, so we look at a lot of positioning, right? We look at a lot of 401ks coming in, and as you'd expect, right, everybody's loaded up on these Qs, right? This fund Q, it's been great for us. It was
been crushing it.
Yeah. So, you look at these people underlying portfolios and they're 40 to 50% in the Qs, and, it's just that self-reinforcing wheel, right? And it keeps going up and they're outperforming. And so we just keep feeding it. And, that's how you get in this, that's how you get in this crazy situation we're in. So, it feels to me like that tide is turning. It should be, when you look at valuation, I mean, all the different stuff that we've talked about and macro and all these different things. But, I don't know, and I'll throw it back to both of you guys on this. I will tell you the risk management side for us, we're pretty good at that. We're usually very good at limiting volatility and holding in there. So I'm not as worried about that. I still think that, at least in my position, I think that money managers are the most afraid of not buying the dip in Qs again. And I get it. That's my fear. I mean, it's just been free money, right? You think about all the research time that guys like us have spent in.
Wasted.
Oh my gosh, right? Like, just like I said, even when we've been right, like a company like PACCAR, they double their dividend and increase revenue by 50% and the stock doesn't go anywhere, right? Where, all you got to do is come out and say you're getting into AI and your stock will double. I mean, it's it's crazy times. So anyway,
This too shall pass.
I think it is. I think we're getting there. But these things always take longer. And I go back to 08 too. And I remember that.
Yeah. They take longer and then they happen faster.
Yeah, it sure seems like that, doesn't it? Like you just have this period of denial and then all of a sudden the dam breaks, right? And the other crazy thing, and we don't need to go down a macro path because I really don't even think this is a macro discussion. I just think people are being very Pollyannish about the impacts of having 0% interest rates for 15 years, amassing the greatest pile of debt in the lowest rates in human history, and then jacking rates to the roof and not expecting things to break. Right? They have to. Like, I mean,
Yeah.
I don't think you need higher rates. I just think you need more time at these rates. So
5% is not a super, traditionally it's not even quite the average. The average is around 6, I think. But clearly we've come, that doesn't mean that the impact's not going to be material because people are planning on the basis of very, very low interest rates. And when rates go up like this, that obviously that must change the plans materially. How does that, if you've got, you can put your money on deposit. I think my money on deposits, just my rate's gone down to 4.4%, but I think you can find better rates out there. I think that Alpha Architect box, which is a really interesting ETF, has a sort of, they give you something like the Fed market rate using a box.
yeah,
It's a little complicated, and I don't fully understand how they actually execute this thing, but they give you basically cash rates, and they're close to like 5.67 with the running an ETF. So there's no flow through. That's sort of contained inside the price. So those returns
is the real.
Yeah, tax advantage, and there's no income flow either. So it's all capital gains. They're transmuted into capital gains. So, which is ideal if you have the tax impact at the time you sell it.
yeah.
But that's 5.67. You start looking around at equities that give you more than, that you like reliably think will give you more than 5.67 or enough to justify
the risk.
Yeah, the risk of being in those equities. Like, there's not a lot that gets over that hurdle at the moment in my world. Anyway, I don't know what everybody else is looking at. Like, what do you guys think about that? Is it time to just jump into cash and ride out the volatility?
So it's funny you asked that question because an ongoing debate that we have had all year long, and the only reason we haven't done it is because of the value that we see in some of the stuff that we're holding, because of the dividends it's paying, because of the cash flow it's paying. But we have been very, very tempted to put anywhere from 50 to 65% of the value portfolio in 2-year treasuries. And I think the earnings, what is the earnings yield on the S&P right now? I mean, if you're trading at 25, 24 times earnings,
yeah, 3 or 4.
Yeah, 3 or 4%. Right. So if I'm going to get 5.2 to 5.5 holding 2-year treasuries in this environment, here's another tell, right? For a value discussion, you can make that 5 to 2, 5.6, like you were talking about, owning treasury type funds, short-term, treasury rates, all that kind of stuff. HYG is paying 5.7.
Yeah. Where's the spread right now?
Holy smokes. I mean, you want to talk about return-free risk? Why are you buying high yield?
It has been softening. It has been softening through the year a little bit, but then so's TLT. TLT is the 10-year, getting absolutely smoked today. So I saw somebody.
It's the 20-year. Actually, it's the 20-year.
20 plus.
20,
yeah,
20 plus. I'm sorry.
Yeah.
That's getting.
I think it's down 50%.
2007. Yeah, right? Something crazy.
I think the number is down. Don't quote me, but I think I looked at it this morning. I think it's 53% from January 1 of last year.
Wow.
How many years of interest payments did you give back in price loss there?
Oh man. I mean, go look at PIMCO total return funds for the last 14 years. I mean, I think last time we looked, I think it's like 1.6 total return. I mean, it's brutal. And to watch high yield, and that gets back to what we were saying. I just don't. These things have to. I mean,
what's the reason for HYG not kind of getting whacked so far? Why is it yielding what it is?
Well, I think people.
It's got a little bit of an equity kind of gamble in it. It's got people who think that it's. What do you think? What do you think? I'm speculating 100%.
I honestly, there really is no explanation for it other than people just being blind to risk. And like I said, I think that's one of the riskiest things here is just it's been good for so long. There's been no real, there's been no real pain that's lasted for any extended period of time. And I think people just get blind to risk. The other thing we are looking at is that you've got, as of a week and a half ago, perhaps it's changed. It doesn't seem like it has. You got retail investors, the most bullishly positioned they've ever been on record. And I think that's possible.
What?
Yeah, no. And guys,
is that a backwards looking measure to what?
I don't, you know what? I didn't.
What are they in? 7,
Qs.
Magnificent 7.
Qs and HYG.
Qs, yeah, Qs.
Yeah.
HYG.
I mean, it's yeah, and you'll hear people support it, and they'll go, "Well, the duration on HYG is pretty small," and you're like, "Are you familiar with the historical default rate and junk debt? Going into a cycle, like you don't need to." It's magical thinking, and I just think risk has been gone for too long. I mean, it's just crazy. There is no logical answer to why HYG is holding in there. There just isn't. It's just flows. I mean, it's not price sensitive. It makes no sense. Why would you buy junk debt paying 5.7 when you can get 30-day treasury funds paying 5.556? It just doesn't make any sense.
I mean, maybe it's an equity type thesis that it bounces back. It's a dip that you can buy. I don't know. I'm speculating purely.
Yeah. I mean, just to watch the way treasuries have been pounded in relationship to the way HYG is holding in there. And I just think we've been talking about it for so long, and I don't want to beat a dead horse here, because if we're going to talk passive, a guy like Mike Green would be a lot better off talking about it than I am. But I just think that passive has run amok, and it's just turned a lot of things upside down. And the funny thing is, and we all know this, but I kind of see it. I kind of see rates going up as sort of like the parents coming home from vacation.
Yeah.
And there was a big party that happened.
Yeah.
Kids went on a bender.
Yeah, because one thing I've been really impressed and I've learned a lot about over this cycle is that, when you've got free money and you've got interest rates at zero and you've got central banks actively trying to, keeping it's not just that we've got rates at zero, but making sure liquidity is ample all the time. There's kind of no gravity, right? There's no limit. Yeah. Like time is on your side as an investor, right? Like you might be going through a rough spot, but if rates are at zero, for the most part, time's on your side. Things get better with time. You throw rates back on at a meaningful level, and now the cost is growing on a daily basis, right? The clock is ticking, and I just don't think people have adjusted to that.
How's that 100-year Austrian bond holding up?
Wasn't it Argentine? I think it was Argentinian.
I think there's a few.
There's a couple, yeah.
Did
I don't know why the US wasn't out there pumping them up.
Oh, what a missed opportunity.
No.
And now the US has got this like huge wall of debt that it's got to roll.
Yeah.
And so of corporates next year. It's all going to happen at the same time.
So that's what we've been talking about too. And I think this is a perfect indicator of the lag effect, right? Like you've been basically bailed out this year just by the way the ball bounced, right? So you had an unusual amount of corporate refinances this year. You go back into next year, there's a ton of them. The same is true on the commercial real estate side, which I kind of think that the issues in commercial real estate are overstated. I don't think that they're overstated as it relates to office space. But I think a lot of commercial real estate is going to be fine. But you look at all of these things, that's what always scares me, man, is when you see not one thing, because usually the market can deal with one thing, but when you see these convergence of these things coming together, student loan repayments getting kicked back on, the commercial or commercial real estate and corporate debt refinancings next year, all of this stuff, you're seeing signs of consumer spending starting to roll over, all of these things coming together at one time. And this is one of the reasons we were pounding on the desk, a year and a half ago, telling the Fed that, look, quit focusing so much just on rates, suck liquidity out of this market, right? That's what's been rates certainly play a role, but it's the constant liquidity injections over the last 15 years that I think have had even a bigger role. Together it's been a pretty powerful cocktail, but
well, I agree. I wondered if the little AI rally that it got called an AI rally, but I wondered if that was the consequences of the SVB bailout.
Well,
Fed's
they have sucked it out now.
Well, Fed's balance sheet was starting to get lowered a little bit and then went back up, but not quite all the way to all-time highs.
Got halfway back. Yeah,
and then now it's been drifting back down again a little bit.
Now they're back below, but now they're back below. I think they're back below where they were before SVB happened. But there's also a little bit of a lag, right? So SVB, was that October last year? Was it
January? I think it's
January. Okay.
Yeah, and then it hit the fan. It was March 10th.
Okay. So that's much more recent.
The reason I know that, and again, it's not 0809. I just think it's really fascinating the way it played out. Lehman, or excuse me, Bear Stearns. No, Bear Stearns failed on March 16th of 08, right? And then you saw that rally, right? You saw that rally, and we're through the worst of it.
Just and then October came.
Yeah, right. Yeah, September. Funny story, actually, Jake. My first day. I worked at Russell Investments before that, but took a job in the financial crisis right before it really got acute as an advisor, because I was 26 years old. And if you're looking for a finance job, if you didn't have a PhD or something like that, which I don't, obviously, but if you were looking for a job in finance back then, the only job you'd get was an advisor. So I took an advisor job, and my first day on the job was the day Lehman folded. September 15th, 2008.
Welcome to the jungle.
Yeah.
Oh my God, man. The guys in the office are looking at me like I'm Jonah, like they got to throw me over.
Yeah, you're Jonah.
Sacrifice you.
Yeah, exactly. Let the big fish eat him, man. He's bad luck.
We got to do Jake's veggies. Jake's got this he renders some scientific or philosophical learnings unto us, and it makes benefit glorious nation of value after hours. And he's got an unbroken streak, so he can't break his streak.
All right. This is going to be like a barely, get you over kind of fastball. But so I happened to come across this little article that was from the Kauffman Foundation and Inc. magazine. And it's actually from 2016 of all things, but it looked at the 5,000 fastest growing companies that Inc. had identified. They do these surveys, and but this then went and looked backwards at like, how did these companies do then over the next, 3 years, I think it was. And it turned out that 2/3 of the companies that they had surveyed had either shrunk in size, gone out of business, or been disadvantageously sold. So, you have this like, here's the all-star list of these, top 5,000 fastest growing companies. And 2/3 of them were worse off than they were when they were identified, right?
Is it just self-reported? How do they know that you're fastest growing?
I don't know, Toby. Let's not get too
coming off a low base.
Yeah.
How'd you go last year?
Yeah, right. Well, and in fairness, a lot of them are off of a very low base, right? Like a lot of them are, early companies. But so Inc. then identified these like 4 stages of growth. And so stage 1 is like the startup finds a real customer for their idea. And I think maybe you would call that like product market fit. Stage 2 is that they establish processes to deliver their product and find new customers. And so that's sort of like, the scaling part of it once you find product market fit. Stage 3 is the enterprise must create more processes, no longer depending upon a special talent of one person, let's say. So it's a little bit more institutionalizing the business. And then stage 4 is creating processes for developing entirely new products for new customers and having a system for that. So it's not just sort of, like one man's genius, maybe. And many of them get stuck between like stage 3 and 4. And it requires this continual reinvention of the company. And I've read before, and I kind of like this idea that if the pace of change inside of your company is slower than the pace of change outside of your company, then you're in serious trouble. And so I think that's what ends up happening to a lot of these companies, is that they kind of get bogged down in one of these stages, and then the world changes around them and they're in trouble. And long-term survival then requires leaders who can craft a culture that rewards both those who bring efficiencies, but also those who can innovate. And so on top of that, then we had Michael Mauboussin released a white paper here, I think last week or recently, and he's talking actually about the 5 stages of the life cycle of a company. So I thought it might be interesting to tie that in with Michael's work as well. And he has then his 5 stages: introduction, growth, maturity, shakeout, and decline. And he references then this accounting researcher's work, this woman named Victoria Dickinson. And she places companies into these different stages based on basically their cash flow statements. So, the operating cash flow, is it plus or minus, the investing plus or minus, and then the financing plus or minus. And you can kind of like actually map out each company depending on where their stage is based on, is it flowing in or out from operations, from financing, and from investing. And, kind of maps as you would expect, like, early introduction company, a lot of outflows in operating as they're getting spun up, right? They're finding their product. The growth companies, they actually start to see some inflows. Obviously, maturity, you see inflows in the operating. Shakeout can kind of go either way. And then declining, you start to get negative outflows in the operating part of the cash flow statement. And of course, you should always, whenever Mauboussin's talking about cash flow statements, you should be making these adjustments on stock-based comp and couple other accounting things that he references. And then on the investing part of it, we could skip through that. That's, it's kind of what you would expect. You can read the white paper. But what then is interesting is you look at the ROIC of the companies at these different stages. And, as you'd kind of expect, the early introduction part of the business has a negative return on invested capital as it's growing. Growth is actually lower than maturity, and then shakeout is a little bit lower than that, and then of course decline, you're back into the negative again. But now this is where it really starts to get interesting, is then he looked at the 3-year annualized total shareholder return based on where that company was at the beginning of that measurement period. So like, we'll put you into a bucket and then we'll measure 3 years, like how did you do as an investor in this company? And so companies this is annualized TSR for the next 3 years. And the introduction side, you're at about negative 10%. So this probably speaks to the power law nature of VC, and the average being not very good. But if you can kind of get into that upper decile, you probably do better. It probably drags up the total. The growth side of thing, which this is where you should really be paying attention, because this is interesting for everyone who's kind of betting on AI and growth and all of this. TSR on that is like 2%. So if you're early in a company that's growing a bunch, and really is sort of, I feel like, emblematic of what probably 2021 most represented, that was that doesn't match the rest of the data historically. And then maturity is the best one, and you're upwards of like 9 or 10% then in TSR. Shakeout comes in around like 6%. And then decline actually comes in at a slightly positive, call it like 1%. So this kind of, to me, tells you to like perhaps focus on companies that are a little bit more mature than what I think kind of the average market participant is looking for these days. And everyone's sort of been chasing growth, but that's historically has not really been the way to bet. But yeah, that's it. That's a little bit of kind of, not the best veggie segment I've ever done, but just a couple little interesting tidbits that I came across last week and threw it out there.
Buffett's just swimming along behind there, along the growth as it turns into mature, just picking them up there.
Yeah, well, and all of those numbers make perfect sense, and I feel like that you may not think that that's the best veggie segment, but I feel like that's going to be one particularly that's going to be studied a lot in hindsight, meaning, I think that investors have forgotten at some point that revenue growth is not what pays you, right? It's profitability. And if you're not worried about profitability, revenue growth becomes a lot easier, right? And if you've got a VC environment that's pumping cash into your system, 0% rates, all that look how many of these companies that we've already seen mature, and none of them have hit their target, what people were expecting out of earnings on it, right?
Yeah. Where are these margins? Where's the economies of scale?
Well, yeah. Blue Apron got sold last week, or it's caught a bid, and it listed at a $2 billion market cap, and it got sold at $100 million.
Yeah.
And how much total capital do you think went into that company over its lifetime to end with a $100 million exit for some of those people?
I'm guessing it's chewed up money at that point. I'm guessing it's down cash on cash.
I would be, man, I would be, if it got up to a $2 billion market cap, I would be shocked. And I mean, don't quote me because I could be off, but I would be shocked if less than 250 to 350 million had gone into that thing.
Oh, I bet it's over $1 billion.
I would think so too, but
I just don't know. Yeah,
we need
but
the hive mind.
Get
on that, please. Tell us what's the answer.
yeah. There's somebody out there that knows.
They had 2 share recombinations, whatever you call that. Not a share split. What's the opposite of a share split?
A
share merger.
Reverse split.
Reverse split. There we go. Reverse split. They had 2 reverse splits. So when you look at the share price, it doesn't quite, if you look at the listing price and the sale price, it doesn't quite do justice to the true carnage that happened on the way through. And they were big reverse splits. They were like 15 for 1, that kind of number.
Just to stay listed, probably sometimes.
Yeah, I think that's right.
Yeah.
Yeah. And this gets back to what we were talking about earlier too, about it not just being, when I look at this market, I see things that remind me of 2000, but not everything, right? Like it, for instance, if you look at a company like Google and go compare it to Netflix, right? The same basic buyers, right? Those are both crowd favorites, more so Netflix. But put those things side by side and tell me if you would pay almost double for Netflix what you're paying for Google. It just doesn't make any sense, right? Like, if you were looking at the cash flow statements and balance sheets and all that kind of stuff, nobody would pay that premium for Netflix. This is what I was saying is I don't think it's as simple as saying that everything's so overpriced. Generally speaking, I think things are, but there's also just these discrepancies that just don't wash, and maybe you're right. Maybe Netflix is going to be the better investment over the next 10 years, because we never know how these things play out. But if you understand basic accounting, no one's buying Netflix at this price when you've got a Google, right? That's the thing that's interesting, or to me is unique about this market, because as much stuff out there is snake poison that I wouldn't touch with my worst enemy's cash. On the flip side, there are great opportunities. At least that's what they appear, for longer term investors.
Cumulative retained earnings and share sales on Blue Apron, 1.6 billion. Oof. I don't think there are many retained earnings there, but I could be wrong. I thought it was loss making the whole way through, but 1.6 billion. That's big. That's a big number. That's a lot of money.
Well, it might be a negative 1.6 billion of retained earnings, which would kind of give you the total. And
share sales, negative 1.6 billion. That is, yeah.
Ouch.
What's been wild to watch about this, though, especially the last 2 years, and I want to hear what you guys have to say about it. What's been wild to watch is there's so many of these companies where you're like, I know where that thing's going, right? But having seen the amount of money people made on those, right? Watching how high they went. Yeah. I mean, holy smokes. And you see that rocket go up, it's coming back down at some point. But I'm not going to lie to you. I really underestimated how crazy it could get.
Oh, it was unbelievable. I said it about Beyond when Beyond had run up a bit. I put out a tweet about Beyond, just saying you've lost your mind at this price, and just the hate mail that I got underneath that one.
Is that right?
And then Beyond, and that was like, I thought Beyond was one of the more. Peloton too.
Oh yeah,
Peloton was just that combination of everybody being locked at home and not being able to exercise, and it being like red hot and right into it. Just, I've never seen anything like that. Given, the history of anybody who's spent any feature of exercise equipment is that it folds up and goes under your bed for when you never ever use it again.
I thought it was like how many clothes can you store on top of it as a rack?
That's it.
This is our net connected interactive clothes hanger.
Yeah.
Yeah. Well, and you saw this, and I've heard you guys have a lot of conversations about this one, especially when it went down. And this is an extreme example, but it really is a good microcosm. We had GameStop on our screens going back to 2015. And
it's like the cheapest. I mean, it was the cheapest thing in my screen for a long time.
Oh, yeah. And just sitting there going, look, this thing's probably dead. Catalyst,
melting ice cube.
Yeah.
Off sheet liabilities in the leases too. That was always a little bit nerve wracking.
Yeah.
Sorry, dude. Keep going.
Yeah, I mean, no, man, it was a dog with fleas to say the least, right? But when it got crushed, we took a position out at about $9.50, I want to say. We had a very tight stop on it. I did not, I'm not going to come back here and say, I just knew.
Wrote
Yeah,
it to 300.
yeah. Oh, no. So this is a perfect example of what I'm talking about. So we got in when Cohen took a spot on the board, because I was at that point, they had 120% short interest. You looked how cheap it was, and I was like, hey, there's a really good chance you could get a short run. And we thought the short run could take it at 35 or $40. That was our outlook. So we bought it between 9 and 10, somewhere in there. And we wrote it up. I went to dump it at 38. By the time the trade went through, it executed at 43. Right. That's how fast it was moving.
Yeah.
I walk out of the office that day with my chest sticking out, going,
Feeling great. And then
oh
there's
yeah. Then it
10x.
10x is in the next 7 trading days. And people are like, why didn't you hold it? And we're like, because we knew it.
It was unholdable.
We knew it was a joke at 35 or 40, you know? And this stuff, and everybody always tells you that. And man, it taught me a lesson. I feel like at the peak of the next cycle, I've written it down, but I need to find a young guy, right?
Oh yeah.
This
Whose
is the
quote was that?
drunken Miller.
Yeah. Because you'd never. Should I have sold the whole position there? No, I probably should have let 100 to 150 basis points ride and stop loss it. But you're looking at it and going, this is just insane. I know what this thing's worth, right? It's not worth anywhere near that. And then it 10x's.
But having said that, we're going to go through a regime now. It'll be like the early 2000s where you buy something and it runs up a little bit. And if you don't sell it, it runs back down again. You know, that's what the value, that's what I remember value being like through whatever it was, 2002 to 2007. You buy something cheaply, but it's not that great. And so when it hits value, if you haven't kind of moved on from it, it just goes back to where you bought it from. Like they just do that. They do that loop for years and years and years without sort of going anywhere. And then you'll be like, you'll be never selling that environment. You're like, where have all my returns gone?
Yeah.
Yeah. Go ahead.
I was gonna say I try to take a little bit of a stoic approach to this, and that there's a certain amount of the return that I deserve for the work that I've done. And then there's other parts of the return that I don't deserve because it doesn't fit with how I want to do things. And if someone else gets that portion of the return profile, then good for them. But that wasn't mine. I'm going to get my safe version that I want to get, and they can have that part.
Yeah. Yeah. And that's very similar to the philosophy that we've deployed. You know, I wouldn't change the way that we did it, you know, or the way that we managed, and we haven't. Because you're right. Like you have to accept the irrational part of this job, you know, and it's going to happen at times, but man, I mean, just real money that's
still fun to watch. And
and it's hard to miss out on, you know, when you're watching everybody. It reminds me that I'm forgetting what his name was. I'm sure you guys know it. The guy on CNBC that comes out and he's talking about this stock, and then they ask him what the company does.
Oh yeah, it was Mark Minervini or something like that.
Sorry,
he should have just said. He should have just said, "That's not what I do. I don't know them that deeply. I look at the trends. I look at the.
Yeah,
I don't care what they do. Yeah, which is probably true. That's probably what he does.
Yeah, and you get into those environments.
It's stressful being on TV. I get it. You say silly things.
Your brain just shuts down.
It does. Yeah, you get that full on fugue.
Yeah.
I know, but you never forgot what a company did, right?
I just didn't know in the first place.
Yeah. Yeah, because that's you getting along without understanding a company. That's your MO.
I have a slightly different perspective to Jake's. That Jake gets the return that he thinks he deserves. I just think whatever you do is going to be the wrong thing. If you sell it, it's going to run. If you hold on to it, it's going to fall back down. So just do what you think you should do, and then just never look at it again, or don't look at it until it comes back into the screen and you got to buy it long again.
Yeah, man, the Costanza portfolio.
I don't Costanza myself. I still try to do what I think I should be doing. It's just that I know that at every single point, whatever I do will be the wrong thing because I have done it. You know, it's like that. It's like that Schrodinger's. Whatever you do is just the wrong thing. So don't worry about it. Just do it and expect it to be the wrong thing.
Yeah.
And move on.
The man in the machine that's constantly taking the counter side of every trade, right?
That would be smart.
Yeah. No, it's Yeah, I've just learned that lesson though, that I think it's really, what's really hard for me is finding that line of being, especially managing other people's money as a fiduciary, finding that proper line of doing the right thing, managing risk properly, but also taking enough. That balance to me is very, very difficult. Especially in this environment. You know what I mean? I would love to hear how you guys balance that, because that's something that we constantly wrestle with, right? Where are we being too conservative? And, I battle with that. I feel like it's like talking about position sizing, like, I don't feel like there is a right
You
answer.
size up the ones that don't work and you size down the ones that do. You never buy enough of the ones that do work.
My similar lament is that you want to be in the market generally, right? Like there's a lot of good, owning American, especially in the last century, but owning global businesses has been a good way to build wealth for a long period of time. And you don't want to, and the timing of these things is incredibly difficult. I don't think it's hard to time markets. It's hard to time factors. However, there are opportunities that occasionally are thrown up that are just so blindingly obvious, and you want to have some dry powder, some part of your capital that's available to jump on those rainy day opportunities. And that then means that capital has to sit there for a long period of time. So how much of it to have in kind of base load, like I'm just going to own a lot of businesses and I'm going to do pretty well on average as a base, and how much do I keep carved out for just the super no-brainers and really being opportunistic? That balance to me is like an interesting, is difficult to thread the needle on.
Yeah, perfectly stated. Nothing to add.
Yeah, no, and I don't really have anything to add either, but I'll lament with you, because that is that, and watching that whole stuff go off in 20 and 21, I understood why those stocks were going up, and we made a few trades here and there. We had a nice 2021, but looking back on it just, we saw what was going on. We should have capitalized on it more.
Stole some equity.
Yeah, we should have been more aggressive. We should have
borrowed $1 billion at 0%.
Raised the spec.
I probably wouldn't have gone that far, right? No 0 days to option expiry in the client's portfolio, but yeah, just knowing when, it feels reckless at times, but knowing when insanity is ruling the day and getting on and riding it, and then because you guys all, as long as I'm really managing my risk and really defining my exposure and things like that, one of the things we tell our clients is you can own anything in a portfolio. The question is, how much do you own, right? It's the sizing that kills you. It doesn't mean everything should belong in a portfolio, but you guys get my drift. But just,
I do. Yeah. We're banging up on time here. Zach,
Oh, yeah,
if
let's
folks
go,
want to get in contact with you, what's the best way to get in contact with you and follow along?
Yeah, best way to do is follow me on Twitter at KYR Radio, or
Know Your Risk Radio.
Yeah, Know Your Risk Radio, and then just Google Know Your Risk Radio podcast. We need to have Jake on. I haven't had him on before, but we have guys. We've had Toby on several times, and do our own little once a week show, and hopefully we bring some value. Folks seem to like it, so as long as they're not booing us off stage, we'll keep doing it.
Thanks, Zach. Thanks, Jake. Zach Abraham, Bulwark Capital Management was. Thank you very much. We'll